Here to discuss his call is Baird's David George. I guess, babies in bathwaters, tarring with brushes. That seems to be what you're saying here. This company doesn't deserve to be hit and taken to the woodshed the way it has been. David?
Yeah, good afternoon, Tyler. Thanks for having me. And that's right. This is, from our perspective, not a crisis, but the banks have been priced as such, and we think that has provided an outstanding opportunity to buy a number of regional banks, and Zions is one of them that we think has conservatively at least 100% upside. The stock trades at less than 5 times earnings. We think the market is pricing in a permanent impairment in profitability, which we simply think is unlikely.
Conservatively, a double. That you don't hear that very often here on CNBC. What is the risk to that forecast here?
Well, the risk, I think, for the most part, is really not a lot of the issues that market participants and the media has been discussing. I don't think deposits will be a meaningful issue. And I think when the banks start to report earnings over the next week or two, we're going to find that results are likely fine for the most part. And the vast majority of the deposit movement that we're talking about has really been confined to the likes of California and New York, and really to just a handful of banks. It's not something that we think is particularly systemic. Clearly, as the economy slows, we're fully on board with the notion that credit is going to deteriorate and really normalize from current levels. To give you some perspective, bank non-performing loans and losses are at multi-year, if not multi-decade lows. So by definition, they have nowhere to go but higher. But at these valuations, again, at less than 5 times earnings, we think that there is a very considerable margin of safety to buy a number of these stocks right here, right now.
So you have Jamie Dimon saying that the current crisis is not yet over, and even when it's behind us, there will be repercussions from it for years to come. How do you coincide his take, his perspective, with what yours is, that this is all silliness at this point?
Well, so we cover JP Morgan, and we've had meetings with Jamie many times over the last 20 years that we've covered the stock. And obviously, we have a ton of respect for him and his views. And there are some things that will have lasting implications. In particular, private equity deposits are going to be something that's going to be that's probably not going to be encouraged by commercial banks. I would imagine that degree of concentration is something that many banks aren't going to be comfortable with. And then furthermore, he talked about a lot of interesting things. One in particular was that federal regulators encourage banks to buy treasuries, and now they're being vilified for them by all the mark-to-market tourists that want to mark these banks to market. So clearly, there are going to be some ramifications, probably on the regulatory side. But again, at these prices, you're getting paid very handsomely to take that risk. And again, that margin of safety, in our view, is very, very high.
All right, David George, thank you for joining us. Appreciate that.